All right, cashing out. As inflation continues to outstrip the value of cash, investors are taking a closer look at liquidity, comparing it to short-term investment instruments, various forms of debt, and of course considering just how much they should have on hand. Well, joining us now with more is Katharine George, Wealthstream Advisors Senior Advisor. Good to see you, Katharine. So for a lot of people wondering, obviously, when you have changing interest rates, when you have inflation, your budget isn't going to be the same as it was. How do you calculate how much cash you need on hand?
So it's really personal circumstance, but I'd say a general rule of thumb is anywhere from, 3 to 12 months of expenses, depending on your job security or, do you have positive cash flow every month? Or any upcoming expenses like a car purchase or a down payment or a home renovation. So really narrowing down what your expenses are and then building up a cash reserve that would satisfy those amount of expenses for 3 to 12 months.
What should that ratio look like? We were asking our guest earlier about, how much you should put money towards investments, how much cash you should be setting aside, how much should be actually being held in a high yield savings so that you get some return on your money. How do you look at that breakdown?
So all of your cash should be earning something, right? So now that we're in a higher interest rate environment, online savings account are a really great alternative to your typical checking, brick and mortar savings account. Online savings account are offering 3.5% in some cases to just have your money sit there. That's free money. So I'd say all of your cash, except maybe your month to month needs, should be earning some of that cash. Now, anything above this target that you have set for yourself and really being disciplined about this target. Once your cash starts to get above, let's say, 6 months of your expenses, then you should really be putting that into the market. It's January, so we always think about going back to the gym and getting fit. And it's not kind of a one-time fix-all solution. It really requires consistency. And it's the same thing with your investments, being consistent with the monthly or weekly investments in the portfolio. And I'd say that, once your cash reserve is established, this is the best time to get in. We think about the saying buy low, sell high. And sometimes it can feel really hard to do that because of where we are in the market, but that's what we're doing right now.
And Katharine, you mentioned discipline and consistency, and a lot of us didn't have any sort of formal training when it came to financial literacy. It was money habits we pick up, and that really does determine how much risk we want to take on, how comfortable we feel taking risk, if we have any sort of cushion. So when people say come into a chunk of money, say a bonus or some sort of raise or something, but you still have the same old mindset, what should you do in terms of applying it to debt? Because obviously not all debt is created equal. You have student loan debt versus credit card debt.
Right. Well, so there's even differences within student loan debt, right? So private versus federal. Right now, the federal student loans are on pause, those interest payments. So you could actually earn more just having your cash sit in, 3.5% online savings account. And that's what I would recommend for that until we're required to start to, pay those down again. But credit cards, you might be paying somewhere in the 20% range, and that is more important to pay down than building up cash. And sometimes even private student loans can be higher yielding debt. So that's important to pay off too. But really, it's comparing what can I earn on this money outside, whether that's investments or cash, versus what am I paying in interest? And that's really where the math comes into play. But when we think about discipline and consistency, whether it's paying off debt or whether it's investing in the stock market, I think it's really important to come up with a plan so that if something comes up, you have something to rely on. So to me, that means, okay, let me take $25 every paycheck and put it into the savings account, and then being disciplined with that. Starting off with a number that feels doable. And once you can master that, maybe you can edge up a bit.
Some good takeaways there. Katharine George, Wealthstream Advisor, Senior Advisor. Appreciate your time today.